Ray Dalio believes that successful investing is not about being smarter than everyone else or predicting the future better than the market. According to him, investing is a lifelong process of learning how the economic system works and positioning yourself in a way that allows you to survive and grow through all types of market conditions. He often explains that the world is far more complex than people assume, and anyone who thinks they can consistently predict short-term market movements is underestimating that complexity. Instead of prediction, Dalio emphasizes preparation. He encourages investors to build portfolios that are strong enough to handle uncertainty, volatility, and unexpected events without collapsing. One of the most important ideas in Ray Dalio's philosophy is understanding how the economy functions like a machine. He explains that the economy is largely driven by credit and debt. When people borrow money, they spend more, which fuels economic growth. Over time, however, debt levels rise to a point where they become difficult to manage. At that stage, growth slows, interest rates change, and economies move into recessions or financial crises. Dalio studied hundreds of years of global economic history and identified repeating patterns in these debt cycles. He believes that investors who understand these cycles are better prepared emotionally and financially when markets decline. Dalio strongly criticizes the habit of reacting emotionally to market news. He explains that fear and greed dominate investor behavior, especially during extreme market conditions. When markets rise, people become overly optimistic and take excessive risks. When markets fall, panic sets in, and people sell at the worst possible time. According to Dalio, this emotional behavior is one of the biggest reasons most investors underperform the market. To counter this, he relies on rules, systems, and data-driven decision-making. By following predefined principles rather than emotions, investors can remain disciplined even when markets are chaotic. Diversification is one of Ray Dalio's most famous principles, and he often refers to it as the holy grail of investing. However, he clarifies that diversification is not simply owning many stocks. True diversification means holding assets that behave differently under different economic conditions. Stocks tend to perform well during periods of economic growth, while bonds may perform better during slowdowns. Gold and commodities can protect against inflation, while cash provides stability during uncertainty. By combining these assets intelligently, investors can reduce overall portfolio risk without sacrificing long-term returns. Dalio's all-weather strategy is built on this concept of balance and resilience. Risk management sits at the center of Dalio's investing philosophy. He believes that most investors focus too much on returns and not enough on risk. Instead of asking how much money they can make, Dalio encourages investors to ask how much they could lose. Large losses are extremely difficult to recover from, and avoiding them should be the top priority. According to Dalio, even a brilliant investment strategy can fail if it exposes an investor to unacceptable levels of risk. Managing risk properly allows investors to stay in the game long enough for compounding to work in their favor. Another principle Dalio emphasizes is humility. He believes that no one, regardless of experience or intelligence, is right all the time. Markets constantly change, and unexpected events can prove even the best investors wrong. Dalio encourages acknowledging mistakes openly and learning from them. At Bridgewater Associates, mistakes were treated as learning opportunities rather than failures. This mindset allowed continuous improvement and better decision-making over time. Dalio believes that pain plus reflection leads to progress, and investors who avoid confronting their mistakes repeat them. Dalio also highlights the importance of studying history. He explains that while technology evolves, human behavior remains largely unchanged. Greed, fear, optimism, and panic repeat across generations. By studying past financial crises, market bubbles, and economic collapses, investors can recognize warning signs and avoid repeating the same mistakes. Dalio personally spent decades analyzing historical data to build models that guide his investment decisions. He believes history serves as a roadmap that helps investors understand what could happen in the future, even if exact outcomes cannot be predicted. Time and patience play a critical role in Ray Dalio's approach to wealth creation. He frequently discusses the power of compounding, where small, consistent gains accumulate into significant wealth over long periods. However, compounding only works if investors avoid major losses. That is why Dalio emphasizes consistency over aggressive risk-taking. Investors who chase quick profits often destroy their long-term potential by exposing themselves to unnecessary risks. Patience, discipline, and long-term thinking are far more powerful than short-term speculation. Balance is another key element of Dalio's philosophy. Extreme positions create fragility. Investors who put all their money into one asset or one strategy expose themselves to unnecessary danger. Balanced portfolios are more adaptable and resilient. While they may not always deliver spectacular short-term gains, they protect investors from catastrophic losses. Dalio often explains that the goal is not to be right all the time, but to ensure that being wrong never destroys you financially. Another key element of Dalio's philosophy is self-awareness. Investors must understand their own risk tolerance, emotional triggers, and financial goals. Blindly copying others or following trends without understanding them often leads to poor outcomes. Dalio encourages investors to develop their own principles, test them over time, and refine them based on experience. Successful investing, according to him, is deeply personal and requires honesty with oneself. Dalio's principles extend beyond investing into life and decision-making. He believes that clear principles help people make better choices under pressure. By defining rules in advance, individuals can act rationally even in stressful situations. This approach reduces emotional mistakes and increases consistency. Dalio views investing as a reflection of how people think, plan, and respond to uncertainty. In the end, Dalio teaches that wealth creation is not about luck, secret information, or perfect timing. It is about building a system that works across different environments, managing risk intelligently, and remaining disciplined over time. Markets will rise and fall, economies will expand and contract, and unexpected events will always occur. Investors who follow strong principles can navigate this uncertainty with confidence. According to Dalio, when principles are applied consistently, investing becomes less about guessing and more about probability, preparation, and long-term success.